Max Keiser.
I'm Stacy Herbert.
Hey, Sweet Pea. So, let me explain something. This guy, Alex Schaefer, before, he was an unknown artist. Now, his work is acclaimed and in demand all over the world. This burn chase portrait, $25,200 on eBay. There's no let-up in demand for burning banks. Stacy Herbert.
Max, that's because he's exposing the confidence game happening around the world, and that's one of our big themes of the show today. First headline reads, Goldman head gold trader speculates about authority intervention in gold, sees precious metal pushing higher. So this is Zach Dabalia, and he's the head gold trader for Goldman Sachs, and he's referring to when the Swiss intervened in their currency market. And the Swiss franc, of course, is a classic safe haven currency. So he said the expectation would be, of course, that gold would rocket on that. But in fact, in the immediate aftermath, was in complete contradiction to prior recent episodes of intervention and what anyone would have expected. Instead of spurring a further gold price rally on the basis that it was one of the few remaining safe haven currencies, we saw a $50 US collapse in minutes. The source of this flow seems hard to pin down, with some speculating over whether authorities were concerned about the signals of an accelerating gold price and its impact on other fragile markets. Soon after, much of the losses were recovered, but the psychological damage had been done.
Well, gold did skyrocket against the Swiss franc. And also, this is World War III. It's gold versus paper. It's authenticity, like gold, versus inauthenticity, like the American paper empire. It's about a new century with new values. And it's about a country like the U.S. with only paper behind it crumbling.
Yes, but it's also part of that confidence game. In order to maintain confidence of the U.S. dollar, everything else must have no confidence. People must lose all confidence in all other things, including gold, which has been a safe haven for 5,000 years. So America is trying with all its might to try to destroy the entire system as we've known it for 5,000 years.
Yeah, when I say nothing behind the U.S. but paper, people will say, oh, they've got 8,000 tons of gold. But keep in mind that you've got a bank like J.P. Morgan. They have sold short the equivalent of many, many, many times that 8,000 tons of gold and silver to support the dollar. So when all the claims are made whole, J.P. Morgan goes the way of Enron to zero, the Fed goes out of business, the U.S. goes into history.
And the other interesting thing here is that many gold analysts around the world claim that it's a conspiracy theory to think that the U.S. government or the CME or COMEX would intervene in the gold market. But here is Goldman Sachs, one of the biggest gold traders in the world, one of the biggest commodity traders in the world, who know these markets, and they're suggesting that there is government intervention.
Right. Goldman Sachs is now agreeing with Gold Antitrust Action Committee, GATA.org, which for years was in the wilderness. People said, oh, it's a conspiracy theory. Now Goldman Sachs, mainstream online schmatas down there on Wall Street are saying, yes, in fact, GATA is correct. The price of gold is manipulated by the paper whores.
And of course, in every single war, there's psy-ops, and that's exactly what this man at Goldman Sachs refers to as a psychological damage. And I want to show you a quick headline in a response to earlier this week when gold fell $50 in a matter of minutes. Joe Wiesenthal said, yow, look what gold just did. So that's the psychological impact they're looking for.
Joe Wiesenthal is the propaganda minister over there at BusinessInsider.com. He puts out propaganda.
No, it's not true.
You didn't say, oh, look at the franc crash.
You're wrong. If he were putting out propaganda, he would be working at the Treasury or at J.P. Morgan. In fact, he is the person who listens to Baghdad Bob, and it's like, oh my God, reporting it in The Guardian and saying, Baghdad Bob says the infidels are being slaughtered at the walls of Baghdad.
Well, if Joe Wiesenthal's not the propaganda meister over at Business Insider, then his overlord, Henry Blodgett, is. Henry, how come you don't come on the show? You keep turning away my invitations, Henry. Come on, be a man.
Okay, well, let's look at some more wars going on. Gaddafi regime sold $1 billion of gold. Well, these are the allegations of Qasim Azuz, the new central bank governor, who said that Gaddafi regime raised more than $1 billion to pay salaries from trading 29 tons of gold with local traders in April, with the metal then possibly being taken out of the country for resale.
So they paid, essentially, the soldiers in paper because they sold the gold, right, to raise...
Well, this is what Kassim Azzouz, the new central bank governor, put in by Sarkozy, Blair, Cameron, and America. So he's their guy in the central bank, and he's saying, it looks like Gaddafi sold 20% of our gold, 29 tons. Now, we're taking at his word that it didn't just go missing, because remember, we, Zero Hedge, others, as the invasion was happening, we said, what's going to happen to Libya's gold?
Well, Gaddafi's still alive, isn't he? That should be a lesson for you out there thinking about buying gold, number one. Number two, he sold his gold for paper, and then he paid his soldiers in paper. So those soldiers are complete idiots if they took paper instead of gold. The whole history of gold, as we learned from our show...
With David Graeber.
Yeah.
He said that gold always comes back into use as a currency because it's used to pay soldiers. So America's trying to tell us it's a psy-ops, that in fact, in this case, they don't want gold. The soldiers didn't want gold. They wanted cash. They wanted U.S. dollars.
Terrible.
But again, you know, the article mentions and points out, this is from the Financial Times, that Gaddafi was unique, Libya was unique, in that their central bank actually held their gold in their country, unlike Chavez, they point out. So a lot of, this is another theme we're talking about all the time, is that many of these nations around the world, including Germany, China, and Chavez, were holding their gold in America, and whether or not they'll ever get that back.
Right, Chavez wants 200 tons of gold shipped back to Venezuela, 100 tons at the Bank of England, 100 tons held by banks like J.P. Morgan, and if he actually delivered that gold, J.P. Morgan, once again, stock price, zero.
So let's stay with Libya here. Tony Blair's Libya policy fueled power obsession of Gaddafi's son. Again, this theme of the confidence game. Tony Blair, snake oil salesman, went to Tripoli, brought in Gaddafi and his son to pretend that they were part, we're giving you our confidence. You're part of this game. Saif al-Islam, you know, as NATO is dropping bombs on him, who is he shouting at? Sarkozy, not at Blair. He still is a victim of a confidence game where he still believes the guy who sold him out is somehow Sarkozy and not Tony Blair.
You know, Tony Blair, if push comes to shove, he should start selling those nut choppers on late-night TV. You know that guy Vince? He's a famous seller of tchotchkes on late-night TV. If he ever retires, get Tony Blair.
You're going to love my nuts. Watch this. So easy. One finger. If I can do it with one finger, you guys can do it with your whole hand. The reason you're going to slap away every day is because it's so easy to clean.
So the confidence game sold to the West and to the people financing it, the taxpayers of the West who think they're getting something, is they're told that Gaddafi and Saif al-Islam are uniquely crazy madmen and dictators and killers. And of course, information has emerged that we were sending people there to be tortured over the past few months, including up to a few days before the regime, we decided to topple them.
That's right. I mean, that's kind of a new revelation, isn't it? Because we knew about Egypt and these other areas where U.S. sent people to get tortured. We didn't know there's actually happening in Libya as well. So, you know, America likes to outsource everything, all the workers, all the work, all the jobs, and all the torture. You know, give those torture jobs to Americans. Why outsource? You know, keep those torture jobs inside America.
So, but the story to the Westerners is always that we're protecting the rebels, we're protecting the freedom fighters of Libya, and it has nothing to do with our oil. We are pure people here. So let's turn to this headline, Turkey to escort Gaza aid ships amid row with Israel. Well, this is Turkish Prime Minister Erdogan, and he's saying that his country is now going to escort Gaza aid ships. And that's the headline chosen here by the BBC. But the rest of the story, I think, reveals the true nature of this religious war going on. Speaking to Al Jazeera, Mr. Erdogan also said Turkey had taken steps to prevent Israel unilaterally exploiting natural resources in the eastern Mediterranean. It appears that Israel has decided to recognize Cypriot rights to the natural gas reserves that are allegedly have been found in the eastern Mediterranean. And now it's a resource war all throughout the Middle East, really. It's about their oil, natural gas, and water.
Yeah, and it's also interesting that the IMF funds finding their way into Greece seemingly were contingent upon Greece shutting down the flotilla of boats from leaving the port of Athens to go to Palestine.
So continuing on with this theme of confidence men, especially those guys operating from J.P. Morgan, one-man lobby, Dimon presses Washington to ease bank rules. This is Bloomberg series, The Influential 50. And this article here is just amazing to read because it's paragraph after paragraph after paragraph of quotes talking about how fantastic Jamie Dimon is. And they come from people like Hank Paulson, and they come from people like some lawyer dude from a Wall Street firm that represents Wall Street bankers. And it says things like, when Treasury Secretary Henry Paulson needed someone to save Bear Stearns from collapse in March 2008, he turned to Dimon.
We've got Dimon. We've got Dimon by the short and curlies. He needs the entire regulatory infrastructure to change to allow his bank to go even deeper into debt to support his naked silver shorts. We've got him. As silver price goes higher, Jamie Dimon is panicking. That stock is like Enron right before it collapsed. Mark my words, hedge funds out there, sell it short, make a bundle.
Well, so continuing on this piece about how their fluff piece on Jamie Dimon, Dimon emerged from the financial crisis a born-again hero. His bank took $25 billion in aid from the U.S. Treasury out of patriotic duty, not because it needed the money.
I pledge allegiance to the flag of the bailout nation of America. Please send me $1 billion, and I'll salute you every morning. Thank you, and have a nice day.
And then it goes on. They then compare him to J.P. Morgan's company's namesake, John Pierpont Morgan. Dimon was heralded as the lender of last resort when other institutions faced a run on their assets.
That's a ridiculous comparison. J.P. Morgan, the big guy, that was his money.
Yeah.
And Jamie Dimon has access to borrowed money. He's a facade.
Exactly. Well, that he has access to the taxpayers' AAA rating to borrow at 0% from the U.S. Treasury and the Federal Reserve Bank on behalf of the U.S. taxpayer.
Oh, you mean AA plus?
AA plus.
All right. Stacy Herbert, thanks so much.
Thank you, Max.
Don't go away. Much more coming away. Stay right there.
Well, when one deals with warfare, it has to realize that there's tremendous amounts of damage that are done, not just human damage, but damage to the physical environment in which the battlefield takes place. Tremendous amounts of damage are done by aerial bombs, by napalm, by chemicals that are used.
Whether it's sonic booms affecting marine mammals, or it's the burning oil fields in Iraq, or it's destroyed coral reefs in the Pacific for landing purposes. The list just goes on and on.
The Geneva Conventions of 1949 states that care shall be taken in war to protect the environment against widespread, long-term, and severe damage. The United States, although it has accepted almost all of the provisions of Protocol 1, has taken exception to that one.
Like millions of Americans, I've lost thousands of dollars in retirement funds, and I haven't had it as bad as many. It's not just about them, it's about me too.
Oh, Lehman Brothers, y'all got the shaft. Shaft! The government said, good luck with that. Shaft! And AIG, old Uncle Sam, he loaned you $85 billion, but now he owns you.
Since this is my film, I get the last word. This financial crisis will not be turned off like a light switch.
Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to New York and talk with Nick Verbitsky. He's the director of a new film called Confidence Game, a documentary that examines the final week in the life of investment bank Bear Stearns. Let's take a look at a clip.
As Bear was shoving billions in dubious loans through its CDO pipeline, management worked hard to cover up any problems along the way. something Van Leeuwen found out when it was discovered that the firm had illegally sold investors millions in securities holding loans originated in West Virginia.
Sometimes corners were cut. According to West Virginia code, you have to be licensed by the state in order to service loans secured by property in West Virginia. It was discovered that Bear Stearns had been buying West Virginia loans for several years now, and were not allowed to service it.
Without reporting the oversight to regulators, Bear enforced a mafia-style code of silence within its walls to quietly fix the problem.
Okay, that was Confidence Game, directed by Nick Verbitsky. Nick, welcome to the Keiser Report.
Hi, thanks for having me, Max.
All right, Nick, before we get into the substance here, tell us a little bit about Bear Stearns. What sort of bank were they? How did they fit into the Wall Street matrix? And when and how did they collapse, just on a timeline?
Well, that's a good question. Bear Stearns was known for many years as the most brass-balled profit powerhouse on Wall Street, and they had a reputation that they really reveled in, which was that they did business with whomever and however they pleased. And for many years it worked to their great advantage as the profits kept piling up. But what eventually happened was fully half of their firm became sunk into the subprime mortgage business. And once we saw a hiccup in that business in '07 when Ralph Cioffi's hedge funds blew up, it was about 9 months later where the firm completely collapsed under its own weight. A lot of people say it collapsed in the space of a week, but when you really look at this story, the demise of this firm was many years in the making. When the firm collapsed, it had $400 billion in assets and only $12 billion in tangible equity. So really what the firm was doing was they were funding their daily operations in the overnight commercial paper market, and what eventually happened was when that dried up, they were refinancing a mortgage on their business just about every day, and when that source of funding dried up, the firm collapsed.
Okay, now the week that Bear Stearns collapsed, I recall that the company was effectively being attacked by naked short sales. These were far more shares being shorted than shares existed for the company. In other words, counterfeiting of shares sold to drive the price down of the stock. Do you have more information on this, and what role did CNBC play in driving this vicious loop of counterfeiting lies on CNBC while counterfeiting stock to sell the company shares down to zero?
Well, there's certainly a lot of talk about naked short selling and how it affected Bear, but really, first of all, we don't have any information on that at this point. The SEC launched a very wide-ranging investigation. When the firm first collapsed, the street was rife with rumors about all sorts of conspiracy theories where hedge funds had colluded to bring the stock down and bring the company down. But really what you started to see was, more than naked short selling, what you saw was an incredible expansion in credit default swap spreads. People were buying insurance on Bear Stearns debt that they didn't actually own. And once that happened, the incredible demand for insurance on Bear Stearns debt widened their credit default swaps and really dried up their sources of funding. Once the overnight lenders and everybody else started to see these things, they all stepped back from the firm and said, well, we don't know how this ends, but, we want to get out of this before, we're entangled in it. So it really, I think that the credit default swap part of the equation is a much bigger story than maybe naked short selling, although naked short selling, I'm sure, had an impact. As far as CNBC goes, especially with regard to credit default swaps, there was a seminal interview between David Faber and Alan Schwartz, then the newly minted CEO of Bear Stearns, on Wednesday, March 12th. And really, the ostensible purpose of that interview was for Schwartz to calm the fears growing around the firm. And before he even had a chance to do that, David Faber threw a question at him based on a credit default position that was looking to be closed out by an investor who later turned out to be Kyle Bass. And apparently Bass told Faber that he couldn't close it out with Goldman Sachs. And once Faber it kind of mentioned that on the air, everybody on the street started running for the doors immediately. And there was really nothing that Alan Schwartz could have done about that. The really troubling thing about something like that is that trade actually cleared the very next morning. There was a point where CNBC kind of stepped over the line from reporting the news to actually making the news, and it really had a material effect on Bear Stearns.
Right, well, a couple of interesting points there. The CDS market, or the credit default swap market, it was really borne out by this particular situation, the risks involved there, when the counterparties involved in that market don't have the wherewithal to cover those bets. famously when AIG collapsed, they were the counterparty for many of the CDS contracts, and the traders on Wall Street know this and write contracts knowing that they'll never have to make good on them because the counterparty's bankrupt. So that's part of the fraud that we see. As far as naked short selling goes, I can tell you personally, having looked at the situation myself and knowing, having invented a lot of the technologies that run these systems, that there was massive naked short selling. It's not a conspiracy theory. It's an absolute stone-cold fact. And it's counterfeiting on a wide scale, and it's pervasive on Wall Street and throughout the U.S. economy. But let's move on. Bear Stearns CEO Jimmy Kane, who was seen golfing while Bear Stearns collapsed. Was it just because, what was that all about? Jimmy Kane, he's very famous on Wall Street for some of his peculiar habits, but what was the story there?
Well, Jimmy Kane was the longtime CEO of Bear Stearns, and since the company had gone public in the early 90s, he had become really a legend on Wall Street. He held over $1 billion worth of the firm's stock, and by far he was the most heavily invested in his own company. And he was really kind of what Brian Burrow in the film calls the last of the Wall Street Buccaneers. He was really an old school guy, and I think that's one of the issues that kind of came back to bite the firm at the end, was that Jimmy wasn't really down and dirty with the business. When Ralph Cioffi's hedge funds collapsed in the summer of '07, he was reported to be in a page one article in the Wall Street Journal on November 1st of that year. It was reported that he was actually playing in a bridge tournament in Nashville, Tennessee, just as these funds were collapsing. And there were rumors that he was a big pot smoker, and he was out playing golf, Thursday through Sunday all summer long, while the fires were kind of burning around the firm and these hedge funds. So, it really became apparent by the fall of '07, about 5 months before the firm collapsed, that, he really wasn't down and dirty with the business. And beyond that, the subprime mortgage business, he really didn't have a good clue about what was happening in that business. And it later came out that really nobody did. The management style at Bear Stearns was very siloed. So different parts of the company really didn't have a clue what other parts of the company were doing. And, at the end, everybody kind of thought the guys at the top had some sort of bird's eye view. But in fact, they didn't. But beyond that, the firm was effectively mortgaging itself and refinancing that mortgage every day for many years in the commercial paper market, and the reason they did that was because it was a lot cheaper to do than taking on long-term debt. There were a lot of things that were done to maximize profits, for the executives at the firm, and certainly Jimmy Kane led that. And at the end, it ultimately doomed them.
How much did J.P. Morgan pick up Bear Stearns for? What was that deal ultimately consummated at?
Well, it was ultimately consummated at about $10 a share. What originally had come out, and the number everybody remembers, is that on that Monday, March 17th, St. Patrick's Day, the public learned that the company was going to be sold for $2 per share. And what happened after that was that which effectively meant that J.P. Morgan was going to buy this firm for barely more money than the firm's headquarters building on Madison Avenue was worth. What happened was that there was a shareholder revolt, and at one point Jimmy Kane was exploring the possibility of actually blowing up the firm and taking it into bankruptcy, and just effectively said, I'm going to take everybody down with me. So after that revolt, it was clear to Jamie Dimon and everybody at J.P. Morgan that there was something that was going to happen. There were some contractual problems as well that left J.P. Morgan exposed. So at the end of the day, the firm was picked up for $10 a share, and they got that deal done in May, a couple of months later. So by any comparison, it is one of the great steals of a buy on Wall Street, probably in history.
Right, and then of course J.P. Morgan, after acquiring those assets for less than pennies on the dollar, they turned around and got multi-hundred-billion dollar bailouts from the American taxpayer. So fantastic for Jamie Dimon. Again, another legendary scamster. Clarify some of the points here. Going back to 1999 and the long-term capital management scandal, when that hedge fund collapsed and Wall Street came together to bail it out with this huge multi-billion dollar bailout, one firm did not participate and there was a stigma attached to that firm. Was that Bear Stearns or Lehman?
It was actually both. Lehman only, every firm on the street was told by the president of the New York Fed that they all had to kick in $300 million per to bail out long-term capital management. What ultimately happened was that Lehman only kicked in $100 million, and Bear pretty much told the Fed to take a hike. Jimmy Kane basically saw Bear Stearns as really a vendor to long-term capital. They cleared all of long-term capital's trades, and he didn't see why he needed to kick in money to save this firm. And in fact, of course, he didn't. And that's really when long-term capital collapsed in '98. That was really when the term too big to fail was coined. And it certainly set up a huge moral hazard problem for Wall Street that we saw rear its head again in '08 on a massive scale. And so, there are certainly a lot of parallels between what happened in 2008 and what happened on a much smaller scale in 1998 with long-term capital management.
All right, so let's talk about what's happening now with the criminal proceedings and lawsuits that have been launched against Bear Stearns, J.P. Morgan, since the collapse. Terry Boole, who we follow on this show, she's been a guest on Keiser Report. You've worked on details that are leading to a lawsuit. Can you give us some details and updates on that?
I worked with after Terry, who's just been a huge fan of the film since day one and done a lot of really great reporting on this subject surrounding Bear Stearns and these other banks. After she wrote an initial article in The Atlantic, I was contacted by a law firm who's bringing an action on behalf of some of the monoline insurers. The biggest thing that's just come out is the FHFA's lawsuit, civil suit, which was released this past Friday, which details actually individual defendants at Bear Stearns, all of whom were running their mortgage operations and are now in very high-paying jobs at other firms. Tom Morano at Ally Bank, Jeffrey Verschleiser at Goldman Sachs. These guys have landed in big jobs at other places. So, and although this is a civil suit, not a criminal proceeding, the word I hear is that based on the outcome of these proceedings, some indictments are being bandied about and talked about. So, I think that after, certainly the Justice Department lost the case against Ralph Ciaffi and his co-manager of the hedge funds at Bear Stearns, where they were acquitted on 9 counts. I think they've really been going to school on how exactly to prosecute these people for the malfeasance that they participated in. And I'm hopeful that some of these people pay for what they did, because certainly email documentation as well as eyewitness information. Apparently more than 30 whistleblowers have come out in some of these suits to describe the incredible level of fraud and malfeasance that was going on, both on the factory floor at Bear's mortgage operation, that really went all the way to the top.
All right, we're going to have to leave it there. Nick Verbitsky, thanks so much for being on the Keiser Report.
Thanks for having me, Max.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Nick Verbitsky. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.